Welcome to the Maybe Not So Great Books channel. You decide. This is lesson 9 of 14, When Wall Street is Not Your Friend, from The Intelligent Investor, the definitive book on value investing by Benjamin Graham. Commentary by Jason Zweig.
It is really good to be back, and today we are sort of stepping away from the usual stuff, the balance sheets, the PE ratios. We're stepping away from that for a moment to look at something that's arguably much more important, which is the battlefield itself.
Exactly. Yeah. This deep dive, it isn't about picking stocks. It isn't about how to value a company or how to read a chart. It is about understanding the environment you are stepping into when you open that brokerage account.
Right.
It's about the structural conflict of interest that sits right at the heart of the financial industry.
And it's a conflict between the industry and you, the individual investor. And I think for a lot of people, this is the hardest lesson to swallow.
Oh, for sure.
Because we want to believe that our financial advisor or our broker or that friendly voice on the financial news channel, we really want to believe they're on our team. We want to believe that when they say buy, it's because it helps us, not them.
Right. I mean, we want a guide. We want a Sherpa going up the mountain.
Yeah, exactly.
But Graham is telling us, quite bluntly, honestly, that the guide might be leading us off a cliff because there's a toll booth at the bottom.
A toll booth they own.
Right. And we are pulling primarily from Chapter 10, which is The Investor and His Advisors, Chapter 19, Shareholders and Managements, and some of the really juicy forensic case studies in Chapter 17.
Yeah, these chapters they're really the wake-up call section of the book. Graham is just stripping away the veneer of respectability from Wall Street and corporate America to show you how the money actually flows.
And usually it flows away from you.
Yes.
Your broker makes money when you trade, you make money when you don't. Graham figured this out in 1949. Why haven't you?
That is the pivotal question right there. It's the question that, honestly, it should be taped to your monitor.
Just a sticky note right on the screen.
Literally. And it brings us right to the hook of this entire lesson, which is what we might call the prudent principle paradox.
I do love a good paradox.
Mm-hmm.
But before we get into the weeds on that, let's clarify prudence. Because in the investment world, that usually means safety, right?
Yeah.
Not taking unnecessary risk.
Exactly. It means margin of safety. It means conservative valuation. It means not buying high-risk junk at the absolute top of a bubble.
Right.
Now, if you ask any investment banker or broker on Wall Street what the principles of sound investing are, they know the answer. I mean, they're smart people. They went to Ivy League schools.
They know the math.
They know the math. They know you shouldn't buy a company with zero earnings at 100 times revenue. They know the history of market crashes better than anyone else.
So they know the rules.
Yeah.
They know how to drive the car safely.
They know them better than anyone. But Graham observes in Chapter 10, and this is a really biting observation from him, he says, Wall Street has a few prudent principles. The trouble is that they are always forgotten when they are most needed.
Forgotten when they are most needed. That almost implies it's intentional. Like they just have selective amnesia.
Precisely. It is selective. Think about a market boom. Everyone is excited, prices are sky high, and these super risky IPOs are just flying off the shelves.
Everyone's making money on paper.
Right. And that is exactly when you need prudence the most. You need someone in the room to say, stop, this is dangerous, this valuation makes absolutely no sense.
But that is also when Wall Street forgets prudence the most.
Yes. And why do you think that is?
Well, because if they tell you to stop, the music stops. And if the music stops, the fees stop.
There it is. Prudence does not generate commissions. Speculation does. Mania does. Activity does. Think about it from their perspective. If a broker calls you up and says, the market is too high, sit on your cash for 2 years.
How does he feed his family?
Exactly. How does the investment bank pay its bonuses? They need you to buy the new thing.
So the paradox is that the experts know how to protect you, but their actual business model prevents them from doing it when it matters most.
Correct. And this creates what we can call the activity trap.
Let's unpack this activity trap.
Yeah.
Because this really is the fundamental misalignment. If I'm a broker, or honestly even a modern trading platform, I need volume. I need action.
The financial industry, and here we are talking about the vast machinery of brokers, dealers, underwriters, and a lot of advisors. It is designed from the ground up to extract fees from activity.
From motion.
Yes. Every time a stock is traded, a fee is generated or a spread is captured. Every time a new company goes public, massive fees are generated. Every time a complex new derivative is invented, fees are generated.
The system runs on friction.
It runs on friction, so their profit model is built on kinetic energy, things moving around, buying, selling, swapping.
But think about the intelligent investor, the way Graham defines it throughout this book. What is the source of the investor's profit?
Patience, holding, compounding, inactivity.
Right.
The investor profits from potential energy, sitting still. You buy a good thing, you verify it's a good thing, and you sit on it for 10 years. But if you do that, your broker starves.
That's such a stark way to put it. If I'm the perfect Graham investor, my broker absolutely hates me. I'm a dead account to them.
You are a terrible client for Wall Street if you are a successful Graham investor. They literally call it dead money.
Wow.
Because you aren't generating commissions, you aren't buying the hot new IPOs, you aren't trading options on margin. And this creates a massive constant pressure from the industry to keep you moving, keep you trading, keep you churning. Because that motion is the friction they harvest.
It reminds me of that old joke, where are the customer's yachts?
Yeah, the banker shows off all the yachts belonging to the brokers, and the guy asks where the client's yachts are. It's not just a joke, it's the structural reality. If your advisor makes money every single time you buy or sell and you lose a fraction of your return every time you pay a fee, you really have to ask yourself a very provocative question.
Which is?
Are you partners or are you the product?
Oof, that hits hard. Are you the partner or the product?
It feels like in the age of free trading apps, which I know we'll get to later, that question is even more relevant now than it was in 1949.
Oh, absolutely.
But let's dig into the core concept here. We're dealing with two main misalignments in this lesson, say. The first is with Wall Street itself, the advisors, the brokers.
Right. This is the agency problem writ large. Let's look at chapter 10. Graham spends a lot of time discussing the fee structure, and he points out this fundamental truth. Most financial advice is sold, not bought.
Meaning nobody wakes up on a Tuesday and says, you know what I really need today? A complex variable annuity.
Exactly. Nobody wakes up craving a structured note. It has to be pushed on them, it has to be sold, and the quote-unquote standard advice you get usually serves the seller first.
Yeah.
But here's where it gets really interesting in the text. Graham had a deep, almost visceral hatred for complexity.
Yes, he talks about warrants, convertibles, all these complex financial instruments.
He disguised them. I remember reading that line from him. Whenever calculus is brought in, or higher algebra, you can take it as a warning signal.
It is one of his absolute best lines. And let's be clear about something. Was Benjamin Graham bad at math?
No. The guy was basically a quant before quants even existed. He was a mathematician by training. He loved formulas.
He was brilliant at math. He didn't hate complexity because he couldn't understand it. He hated complexity in finance because he understood that complexity is almost always camouflage.
Camouflage for what?
For value extraction.
Yeah.
Let's play this out. Let's say I sell you a plain vanilla bond, say a US Treasury bond.
Okay, simple enough.
You can calculate the yield on a napkin. You know exactly what you were getting. You know exactly when it pays out. And you know exactly what the open market price is. It is totally transparent.
Right.
It is very hard for me to rip you off on a Treasury bond because the product is simple. Everyone knows the price.
But if you sell me a structured note with a knockout barrier and a leverage multiplier,
now I have introduced opacity. You don't know how to price it. You don't know what the fair value of that derivative is. You have to rely on my mathematical model, which means I can embed a massive hidden fee inside that complexity and you will never see it.
because it's baked into the algebra.
Exactly. You might think you're paying a 1% advisory fee, but because of the weird pricing structure of the derivative, the bank might be taking 5% or 10% of the value up front before you even get started. Graham saw this happening in 1949 with things like stock option warrants.
He called warrants near fraud, right? Can we define a warrant for the listeners who might not be deep in the weeds on mid-century finance?
Sure. Think of a warrant like a coupon that gives you the right to buy a stock at a certain price later on. So a call option, basically. But in Graham's day, and honestly even today in certain deals, these were often given away for free to the insiders or the underwriters who put the deal together.
So they didn't pay for them.
Right. But what happens if the stock goes up? The insiders use their free warrants to buy shares below market value. This dilutes the value of the regular shareholders who actually put up the real money. Warrants were a way for the promoters to siphon off value from the company without putting their own cash at risk.
So it's essentially a mechanism to transfer wealth from the public to the insiders, and it's all hidden behind a layer of financial jargon.
Exactly. Graham saw that Wall Street invents complex instruments not because they are better for the client's portfolio, but because simple things like just buying a good company and holding it cannot be sold for high fees. Complexity is a weapon used against the individual investor.
Okay, so that's the Wall Street misalignment. The guy's selling us the paper. But then Graham pivots to Chapter 19, which deals with the corporate misalignment, the actual people running the companies we own.
This is the second agency problem, management versus the shareholder.
Graham calls shareholders sheep in this chapter, right? Which feels a bit insulting to the reader.
He does call them sheep. And he says it with a lot of frustration, not disdain. He wants them to be lions. But they act like sheep. He argues that shareholders just accept whatever management tells them. They completely forget who actually signs the checks.
And what is the primary conflict there? Why shouldn't we just trust management blindly? I mean, they are the experts in their specific business, aren't they?
They are the experts in running the day-to-day operations, yes. But think about the incentives regarding capital. Management, the CEOs, the executives, they are the agents. They are supposed to work for the principals.
Which is you, the shareholder.
Right. But in reality, management works for themselves.
And where does this show up most clearly in the financials?
In the battle over retained earnings. This is the cash the company makes in profit that it does not pay out in dividends.
Okay, so the company makes a profit. Graham says that money rightfully belongs to the owners.
Correct. But managers love to hoard cash. They absolutely love retained earnings because a bigger empire justifies a higher salary. A massive pile of cash makes their job safer. It's a rainy day fund that protects them from getting fired, not necessarily you from losing money. It allows them to make huge mistakes without going bankrupt.
So they keep the money to build statues to themselves, basically, or to buy a corporate jet.
Or to buy other companies just to get bigger, even if those acquisitions destroy shareholder value. Graham's core argument here is this: if the company cannot earn a superior return on that cash, if they can't reinvest it at a high rate internally, it should be paid out to the owners as dividends. Let the owner decide where to put it.
But the managers don't want to give it back.
No, it is physically painful for a manager to shrink their empire. And Graham has this great quote. He says, "The typical management will operate with more capital than necessary if the stockholders permit it, which they often do."
This feels a bit abstract when we talk about millions of dollars in multinational corporations. So let's use that analogy you mentioned to me earlier, the pizza shop.
Right. Let's make this super concrete. Imagine you, the listener. You buy a local pizza shop. You put up the money. You own 100% of the equity. But you don't want to actually make the pizzas every day, so you hire a manager named Bob.
Okay, I own the shop. Bob runs the shop. Bob is the CEO.
Right. The shop is a gold mine. At the end of the year, there is $100,000 in pure cash profit sitting in the register. That is your money. You are the owner. You took the risk.
Sounds great.
You have plans for that money. You want to pay your mortgage or go on vacation, or maybe you want to invest in a completely different business, a laundromat. So you go down to the shop to collect your profit.
I'm ready to get paid. Hey, Bob, open the register.
But Bob stands in front of the register, crosses his arms, and says, "No, I'm keeping it."
Excuse me. Bob works for me. I can literally fire Bob.
Bob says, "Look, I need to keep this $100,000 just in case flour prices go up. Or maybe I want to buy a second pizza oven."
But Bob, we aren't even selling enough pizzas to keep the first oven busy. We don't need a second oven.
Bob doesn't care. He wants a bigger kitchen. He wants to manage a bigger operation because then he can call himself a multi-oven logistics manager and demand a raise next year. So he keeps your money in the business. Now, in the real world, if you owned that private business, what would you do?
I'd call the police or I'd fire Bob on the spot. It's my money.
You would fire Bob immediately. But Graham points out that stock investors accept this exact behavior from public company CEOs every single day. The CEO hoards the cash, invests it in low-return pet projects, and the shareholders just shrug and say, "Well, he knows best. He's the CEO."
We act like sheep. We let Bob keep the money.
We let Bob keep the money. We forget that we are the boss. Graham calls for business-like investing. He says, investment is most intelligent when it is most business-like.
Meaning?
Meaning you have to treat your stock ownership not just as a ticker symbol that blinks green or red on a screen, but as a legal partnership in a real business where you have actual rights.
That is such a powerful shift in mindset. It stops being a gambling chip at a casino and starts being an ownership stake. It reminds me of looking at a rental car versus your own car. You drive the rental car differently.
Yeah.
Graham wants us to wash the car, check the oil, and make sure the engine's running right.
Exactly. And sometimes you have to take the keys away from the driver.
Which leads us perfectly to the stories. Graham doesn't just theorize about this stuff in a vacuum. He lived it. And he fought these battles. I think this part of Chapter 17 is fascinating because it shows a side of Ben Graham we don't usually see. We think of him as this dusty academic with a chalkboard, but he was a fighter.
He really was. And the first story, the story of Northern Pipeline, is essentially the origin story of modern shareholder activism. This is young Graham in 1925.
This is way before he wrote the book, before he was the dean of Wall Street.
Decades before. He's a young money manager. He's digging through these obscure filings from the Interstate Commerce Commission, the ICC.
These were documents nobody else read, right?
Nobody. These were dusty, boring government reports physically located in Washington, D.C. You couldn't just Google them. And he finds this company called Northern Pipeline. It's a subsidiary of Standard Oil.
Standard Oil. Rockefeller country. You generally don't mess with the Rockefellers. That's like messing with the federal government, or honestly, probably worse back then.
Big time. The stock is trading at roughly $65 a share on the market. It was a sleepy, boring stock. But Graham looks at the actual balance sheet in these ICC filings and sees something incredible. The company is holding railroad bonds, high-quality liquid railroad bonds worth roughly $80 per share.
Wait, let me do the math on that. The whole stock costs $65 to buy, but they have $80 per share just in bonds sitting in the bank.
Yes. Plus, they had the actual pipeline business, which was generating a profit on its own. So effectively, you are buying $80 of hard cash equivalents for $65, and you are getting a free pipeline company thrown in on top of it.
That sounds impossible. That's a free lunch.
Yeah.
Why in the world was it trading so low?
Because it was boring. Because Wall Street analysts weren't looking at the ICC filings. But mostly because nobody thought the management would ever give the money back. It was a bank pretending to be a pipeline.
The Bob the Pizza Manager problem.
Exactly. The Rockefeller interests ran it, and they liked having that massive pile of cash. It gave them power. It gave them stability within their broader empire. They didn't need the dividend income personally, so they just didn't pay them out.
So what did Graham do? Did he just buy the stock at 65 and wait patiently?
No, because he knew if he just waited, they might have sat on that cash for another 20 years. This is where that business-like attitude comes in. Graham bought a bunch of the stock, and then he started a war. He went to the shareholder meeting.
I just imagine a young Ben Graham walking into a boardroom full of Rockefeller oil tycoons and their lawyers.
It was literally David versus Goliath. He had to rally proxies. He had to convince other shareholders, who were very used to being sheep, to vote with him against the board. He told them, "This is your money. Why are you letting them keep it? Why are you letting them earn 3% on railroad bonds when you could have the cash in your own pocket?"
It's got to be hard to convince sheep to revolt. Usually shareholders just rubber stamp the proxy and vote with management by default.
It was incredibly hard. Management fought back hard. They sent out letters telling shareholders Graham was a troublemaker, a speculator, a New York hustler who didn't understand the pipeline business.
But Graham had the math on his side.
He had the math, and he had the unassailable logic of ownership. He won enough votes to get seats on the board of directors. And from the inside, he forced them to pay out a special dividend of $70 per share.
That is incredible.
Think about the return. The stock cost him $65. So the shareholders got all their initial investment back in cash, plus a $5 profit, and they still fully owned stock in the pipeline company, which was now trading at a rational price based on its actual pipeline earnings.
That is the ultimate proof of concept for his entire philosophy.
It proved two massive things. One, the market price can be totally demonstrably wrong. And two, management will act in their own self-interest, hoarding that cash until the owners step up and physically force them to do the right thing. It showed that the prudent man sometimes has to be a fighting man.
That's a great success story. But Chapter 17 is also full of horror stories. And the big one, the absolute Titanic of its day, was Penn Central.
Penn Central. This is a story that every single investor needs to know. It was the largest railroad in the United States, a massive foundational blue-chip company. In 1968, the stock is trading at 86.5. Everyone owned it. Widows, orphans, pension funds.
It was considered completely safe.
It was the definition of too big to fail. 2 years later, 1970, it files for bankruptcy. The stock goes to zero. Wiped out.
How does a pristine blue chip go to zero in 24 months? And more importantly for this lesson, why didn't the Wall Street experts warn anyone? Where were the analysts? Where were the highly paid auditors?
That is exactly Graham's question. He does a forensic analysis on the Penn Central crash, and he points out one glaring red flag that anyone could have seen if they just bothered to look.
What was it?
Penn Central had paid zero income tax for years.
Zero tax.
Yeah.
But they were reporting record profits to their shareholders.
Yes. They were putting out these glossy annual reports telling shareholders, look how much money we're making, our earnings per share are growing. But simultaneously, they were filing returns telling the IRS, we made no money. In fact, we lost money.
Now, I am no forensic accountant, but if you tell your shareholders you're rich and you tell the IRS you're broke, one of those statements is a lie.
Exactly. And usually, the one you tell the IRS is the truth. Because you go to federal prison for lying to the IRS. You don't go to jail for optimistic accounting in a shareholder report, at least not nearly as easily.
So Graham's point is, always check the tax bill.
If a company is reporting massive profits but isn't paying taxes, its earnings are probably fake. They are accounting constructs. Maybe they're swapping assets back and forth, or capitalizing expenses they should be writing off, or doing some fancy bookkeeping. But actual cash profits generate actual tax bills. No taxes usually means no cash.
So why didn't the analysts scream, sell from the rooftops? The tax data was public. It was right there on the footnotes of the financials.
Because of the conflict of interest we talked about, Penn Central was a huge, lucrative client for the Wall Street investment banks. They issued bonds, they structured deals, they needed constant financing. The banks made massive fees from Penn Central.
Yeah, the fee machine again.
Right. If an analyst at one of those major banks put a sell rating on Penn Central stock, the bank would lose the client. The CEO of Penn Central would simply call the CEO of the bank and say, fire that analyst today, or we take our bond business to your competitor.
So the gatekeepers were essentially paid to keep the gate wide open.
They were highly paid to look the other way. The prudent principles were ignored because it was incredibly profitable for the advisors to ignore them. They sacrificed their retail clients, the investors, to please their corporate customers. It is the agency problem in its purest, ugliest form.
And then there's the third story Graham uses, Ling Temco Vought, LTV. Which honestly sounds like a sci-fi villain corporation.
It really does. LTV was a conglomerate. This was the late 60s craze on Wall Street, the conglomerate boom. James Ling was the CEO, and he just bought everything in sight.
Just rolling up random businesses?
Completely random. Steel mills, meat packers, electronics manufacturers, rental car companies, sporting goods. He built this massive, incoherent empire.
And the stock went crazy, right? It was a darling of the era.
Oh, it was a rocket ship. It went from a split-adjusted low all the way up to $111 a share, and then the music stopped. It crashed to $7.
Ouch. From a 111 down to 7, that's like a 93% loss. That destroys retirements.
And the mechanism of that destruction was debt. He borrowed massive, unprecedented amounts of money to buy these unrelated companies. He was leveraging the parent company up to the eyeballs. And Graham asks a very simple, piercing question. How could the bankers lend so much money to such a fragile, obvious house of cards? It was visibly dangerous. The interest payments alone were eating them alive.
Let me guess. Fees.
Fees. The bankers got a fat fee on every single acquisition. Every time James Ling bought a meatpacking plant, the bankers got paid a percentage of the deal size. They financed the destruction of shareholder value because the process of destruction was profitable for them.
That is the activity trap again. The process of doing the deal matters more to the banker than the outcome of the deal.
Precisely. It didn't matter to Wall Street if the deal made long-term business sense. It only mattered that the deal closed. The bankers got their check at the closing table. The shareholders got the bill a few years later when it all collapsed.
So, we have these historical examples, Northern Pipeline in the 20s, Penn Central and LTV in the late 60s. But I know what some listeners are thinking right now. They're thinking, that was 1970. That was the era of paper ticker tapes and smoke-filled rooms. We have the internet now. We have the modern SEC. We have radical transparency. We have financial Twitter. Surely the system is cleaner now.
Yes. The "this time is different" fallacy, the four most dangerous words in finance.
Right. So let's pivot to why this matters today. Because the mechanism of extraction has definitely changed, but the intent hasn't, has it?
Not at all. The plumbing is different, but the sewage is exactly the same. Let's look at the free trading app. This is the modern brokerage model in 2026.
Zero commissions, no fees to trade. It sounds genuinely great for the consumer. I mean, Graham would have loved low costs, right?
Yeah.
He was famously a cheapskate.
He would have loved the low cost, sure, but he would have hated the business model behind it. Because think about it, if you aren't paying a commission, how is the broker making billions of dollars? They have thousands of engineers to pay, massive server farms to run, fancy headquarters in Silicon Valley. They aren't a charity.
Payment for order flow.
Right. That's a big part of it. They sell your trade orders to high-frequency trading firms who front-run the spread. But more importantly than that, their overall revenue correlates directly with your volume. They need you to trade more often.
Which perfectly explains the confetti.
Exactly. Have you noticed how these apps are designed? They don't look like Bloomberg terminals. They look like video games. They use vibrant, bright colors. When you buy a stock, virtual confetti explodes on your screen. You get constant push notifications. XYZ is moving. Don't miss out. Top movers of the day.
It feels exactly like a slot machine in Vegas.
It is a slot machine interface. It is deliberately designed to gamify investing. It creates a dopamine loop in your brain. It nudges you constantly to act, to pull your phone out of your pocket, to buy, to sell, to check the chart, to do something.
It's the activity trap completely digitized.
Yes. Graham's warning about your broker needing activity is now an AI algorithm living in your pocket. It is specifically designed to make you speculate rather than invest. Because if you buy a boring index fund and hold it for 10 years, that app makes very little money from you. But if you are day trading options on meme stocks on your lunch break, you are a gold mine. You are their favorite type of customer.
And what about the products themselves? Graham hated warrants because they were near fraud. Do we still have those running around today?
We absolutely do, but we gave them a trendy new acronym in 2020. We called them SPACs, Special Purpose Acquisition Companies.
Oh man, the SPAC boom. That was wild. Everyone had a SPAC. Athletes, rappers, retired politicians. Seemed like the easiest money in the world.
It was a classic mania. And structurally, a SPAC is very similar to what Graham warned about with warrants. You have a sponsor who creates the empty shell company. They raise money from the public, promising to go buy a real business later. But here is the kicker, and it's the part nobody read in the prospectus. The sponsor typically gets 20% of the company for free.
For free.
Usually for a totally nominal fee, like $25,000, they get stock worth tens of millions. This is called the sponsor promote.
Wait, so let me get this straight. Before the company even starts operating, before they even find a business to buy, the retail investor who buys the stock is instantly diluted by 20%.
Right. So if you put in $10 to buy a share of a SPAC, you effectively only have $8 of working capital going to work for you because $2 is implicitly owed to the sponsor right off the bat. The sponsors and the investment bankers who underwrite the deal, they get incredibly rich just by doing the deal. It literally doesn't matter if the company they eventually buy is complete garbage.
It's LTV all over again. The bankers get paid for the process, the shareholders get left holding the bag.
Exactly. Graham called warrants near fraud. If you looked at the SPAC performance from 2020 to 2023, where most of them lost 50, 70, sometimes 90% of their value, he would stand up and say, "I told you so." The structure guaranteed that the insiders would win and the outsiders would lose, unless the target company turned out to be an absolute miracle.
And then there's the accounting tricks. We talked about Penn Central avoiding taxes to hide their losses. What's the modern version of fake earnings?
Adjusted earnings.
Or non-GAAP earnings. This is rampant right now, especially in the tech sector.
Ignore all the bad stuff earnings. We made a huge profit if you just ignore all the money we spent.
Essentially, yes. Companies today routinely report two different numbers in their press releases. The official accounting number, GAAP, which often shows a massive loss, and their own custom-adjusted number, which magically shows a profit.
And what do they adjust out? What are they hiding? The biggest one by far is stock-based compensation. They pay their engineers and executives heavily in stock instead of cash. Now, this is a real expense. If I pay you in stock, I am printing new shares, which dilutes the existing shareholders. It has a real, tangible cost to the owner. But companies pretend it doesn't count. They add it back to the earnings as if it was free money.
That's like me saying, I saved a ton of money this month if you just ignore my rent payment.
It is exactly like that. Or saying, I lost 5 pounds this week if you ignore the 3 pizzas I ate on Saturday. And Wall Street analysts, just like with Penn Central in 1968, they play along with the joke. They accept these fake adjusted numbers and build their models around them because they want access to management. They want to be invited on the quarterly conference call. If you start asking tough questions about GAAP accounting, you get cut off.
So the structural conflict of interest remains completely unchanged. The analysts are still just cheerleaders.
They are. And look, to be fair, not all of them. There are some very rigorous, good analysts out there. But the system incentives are overwhelmingly tilted toward optimism and activity. It pays to be bullish. It pays to be complicated.
It's honestly terrifying how consistent human nature is over 70 years. But I think we have to address the limitation of this lesson here. Because if you take this warning too far, you just become a paranoid conspiracy theorist. You wrap your money in a mattress, buy gold bars, and stockpile shotgun shells.
Correct. The danger of this specific lesson is crippling cynicism. If you believe every single advisor is a crook and every single CEO is a cash-hoarding sociopath, you become paralyzed. You miss out on the miracle of compound interest and capitalism. And make no mistake, capitalism, for all its flaws, is a miracle for wealth creation.
So who are the good guys? How do we filter the signal from the noise?
While Graham acknowledges that good, honest advice is actually worth paying for, the modern solution to the broker conflict is finding a fee-only fiduciary.
Explain the difference for the listener. What makes a fiduciary different?
A fee-only fiduciary does not get commissions. They do not make a dime when you trade. You pay them a flat, transparent fee or a percentage of your total assets to give you comprehensive advice. By law, they sit on your side of the table. Their legal and financial incentive is to keep you happy and grow your wealth safely, not to churn your account. If your account grows over 10 years, their fee grows. That is structural alignment.
So the structure really matters. You want an advisor whose paycheck depends entirely on your long-term success, not your short-term activity.
Structure is everything. Show me the incentive, and I will show you the outcome. And on the corporate side, we also have to be fair about retained earnings. Graham's militant demand for dividends, give me the cash right now. That makes perfect sense for a mature railroad or a steel mill in 1940. Those were capital-intensive, slow-growing industries.
But not for a tech company in massive growth mode.
Exactly. Think about it. If Apple had distributed all its spare cash in 2005 as dividends, exactly as Graham would have demanded, the iPhone might never have been funded. The R&D would have been starved. If Amazon paid out all its profits in 1999, they would have gone bankrupt during the dot-com crash. If Google paid out all its early profits, we wouldn't have Google Maps or their cloud infrastructure.
So retained earnings are only intrinsically bad if management is incompetent or if the core business is totally mature with nowhere to grow.
Right. If the company has a massive moat and can take $1 of your cash and internally turn it into $5 of market value over 5 years, you want them to keep it. You beg them to reinvest it. The core problem is that most managers think they are the next Steve Jobs, but most managers are actually just Bob the pizza guy buying a second oven he doesn't need.
That's the blind spot. You have to actively judge the capital allocation skills of the management. You can't just apply Graham's dividend rule blindly to every modern company.
You can't. Which brings us to the big debate angle for this lesson. If the system is rigged towards fees, and if monitoring management is this much hard work, what is the best response for the average person? Do you stay and fight it, or do you just leave it entirely?
The classic exit versus voice debate.
Exactly. The exit argument in investing is basically passive indexing.
Which Graham actually eventually supported, right?
He did. In 1976, just shortly before he died, he gave an interview where he basically admitted that most individual investors should probably just buy index funds. Why? Because it completely removes the advisor conflict. An S&P 500 index fund has rock-bottom fees, no commissions, no active trading, no churning.
And it removes the management conflict to some degree, too, because you aren't betting your retirement on one specific CEO, being honest.
Right. It diversifies away the specific risk of a Penn Central. If one company goes bankrupt due to fraud, it's a tiny fraction of your portfolio.
Yeah.
It is the ultimate defensive move. You are essentially saying, I know I can't beat the system, so I will just buy the whole system at the lowest possible cost and ride the general growth of the American economy.
But there's a counter-argument to that. The fight argument, the activism route.
Right. This is the voice option. If everyone indexes, if literally every share of stock is held by passive Vanguard and BlackRock funds, who is actually watching the store?
Who holds the CEO accountable?
Exactly. If every shareholder is a passive index fund algorithm, the northern pipeline managers of the world can hoard cash forever. They can pay themselves massive unearned bonuses. They can buy fleets of corporate jets because no modern Graham is going to bother reading the ICC filings, going to the meeting, and fighting for the proxies.
So passive investing essentially creates a massive free rider problem. We all benefit from the active hedge funds and activists who keep market prices honest and fire bad CEOs. But if everyone decides to be passive to save on fees, the honesty disappears.
That is the ultimate dilemma of modern finance. Passive indexing is demonstrably best for the individual. It saves you time, it saves you fees, and it lowers your stress. But it might actually be bad for the market as a whole because it removes the sheriffs from the town.
So we need some people to be active.
Yeah.
We need some people taking the pain.
We need some people to be business-like owners. We need the wolves of Wall Street, the aggressive activist investors, to hunt down the lazy, bad management teams. We need that friction to keep the system honest for the rest of us.
Man, so what does this all mean for the listener right now? We've scared them about brokers, we've warned them about cash-hoarding CEOs, we've debated the merits of indexing. What is the actual takeaway?
The takeaway is this: be the owner. You have to fundamentally shift your identity when you interact with the financial system.
Give me actionable steps. Monday morning, what do I actually do?
First, audit your incentives. Look closely at your fees. Log into your account and see what you are actually paying. Are you paying a percentage of assets? Are you paying hidden trading commissions or massive spreads? Is your financial advisor a fiduciary in writing? If you don't confidently know the answer to those questions, find out on Monday.
Follow the money. You can't see the fee, it's probably way too high.
Always follow the money. Second, look at your actual holdings. If you own individual stocks, not just funds, do you know why management is keeping the cash? Have you ever opened a proxy statement?
The proxy statement. That's that incredibly boring, thick document that comes in the mail that literally everyone throws directly into the recycling bin.
It is the single most important document a company produces. It tells you exactly how much the CEO is paid. And more importantly, it tells you what specific metrics determine their cash bonus. If their bonus is tied solely to revenue growth regardless of profit margins, guess what? They are going to acquire terrible companies and destroy your value just to grow top-line revenue.
Just like LTV in the 60s.
Just like LTV, you have to realize that you are the boss. The CEO works for you. The broker works for you. If their behavior doesn't make you money over the long term, you have the power to fire them, sell the stock, move your account.
You adopt the Northern Pipeline attitude.
The value is in the assets, not the hype. And the final truth of Wall Street is this: nobody cares about your money as much as you do.
That is the bottom line right there. Nobody cares about your money as much as you do. Wall Street is a business, it's not a charity, and it's certainly not your friend, it's a counterparty.
Treat it with respect, learn the rules, but keep your hand firmly on your wallet at all times.
That was lesson 9 of 14 on The Intelligent Investor, the definitive book on value investing. Subscribe for the full series. If you haven't seen our debate overview of the whole book, check that out, link in the description. Thanks for being here. See you next time.